Hello, everyone. Welcome back to the PetroNerds podcast. This is episode 113 of the PetroNerds podcast. It is August 14, 2024. My name is Trisha Curtis. I am the CEO of PetroNerds and host of the PetroNerds podcast. And boy, do we have a lot to cover today. So I'm going to try to style this podcast in some ways like I do the short 2-minute videos that go really, really well on Twitter and LinkedIn, where I put a post with sort of the news that's going on with that. We'll see how that goes. I want to keep this sort of short and sweet while getting into, all the macro details and what's going on with oil prices right now. And the biggest things I want to talk about and cover today are the oil price drivers and oil price volatility and these hot wars and the geopolitics and then the economy. So what we're seeing, what we saw a couple weeks ago with this yen carry trade, the volatility, the VIX index going crazy, a sell off in stocks, and a subsequent sell off in oil, and all this craziness. So I want to put that in context, but within that, there's a ton going on. So we have the election backdrop, which is kind of just it's just humming along with the U.S. political election. You have a massive escalation, I would say, a material and serious escalation on geopolitics and on war that I don't think is really being appreciated by the market. And I say this a lot, in terms of the stock market not appreciating something, and maybe even oil prices not appreciating it. And so there's a lot of push and pulls on oil prices that I think we need to revisit as of August 14, 2024. What's going on within oil prices, given that we have Ukraine actually going into Russia, and the fact that we have Hamas or Iran looking to retaliate on Israel because Israel was able to knock out their leader, who shockingly was, and this, so that's sarcasm, folks, who was actually in Iran. So, and you have that's why you saw oil prices go up to $79 a barrel earlier this week. We are down to 77.22 today. So I'll put the timestamp in right now. Right now, WTI West Texas Intermediate is at 77.22. We're looking at Brent at 79.77. So we're just under that $80 threshold. Nat gas Henry Hub is at $2.22, 222. And we're looking at the 10-year yield, and we're definitely going to get into this, is the 10-year yield is at 3.833%. So when we saw the 10-year-old come below 4%, and we saw this in this yen carry trade and this sell-off, we definitely saw a lot of volatility there. So we saw a sell-off, we saw yields go lower, and then we saw a sell-off on the stock market. So what we're seeing right now is the inflation data, the CPI or consumer price index came in today, and that helped the yields go lower. And that yields going lower corresponds, as I've mentioned a lot, the 10-year yield is something to really, really watch. But watching it, especially with a 30-year mortgage, because the 30-year mortgage is at 6.55%. Now, if you've listened to previous podcasts, you listened to especially the last one, the AAPL keynote, you hear me talk a lot about consumer debt and talk about household debt and mortgages and housing. And so, people say, well, if the Fed lowers rates at a quarter point, what is that really going to do? Well, it's a signal. And will that really do anything on mortgages? Well, a lot of the market is already doing this for them if you're seeing a drop in mortgage rates. But I would argue that 6.55% is not enough to really incentivize people to buy. Now, there is a massive slug of people refinancing, a huge number. I heard refinancing was up like 35%. Now, that should be worrying to folks, because when I talk about that debt levels and the trillions and trillions we have in mortgage debt, everybody sort of says, oh, that's not that bad because so many of these mortgages were bought under fixed rate at under 3% or around 3%. And I would argue if you're having this much refinancing, that you have a lot of mortgages that are much higher than that. And if you're refinancing from the sevens to 6.55, and you've saw that surge, and I don't know the actual numbers, I need to look into that. But if we're talking a material amount of people are refinancing, that means that you will have a lot of at-risk mortgages, or at least a lot of the dollar amount is high. So maybe we've had less transactions, but because prices have been so high, people are if you're mortgage is 7% for $1 million home, that's a lot. And so this stuff is stuff that gets at risk, because what we saw and what was part of this crazy sell-off in the past couple weeks, when we saw this, when I gave that short video on LinkedIn a couple weeks ago when I was out of Northwest Colorado with my folks, was that we saw the unemployment rate. So it was the Friday jobs data had come in, and the unemployment rate had ticked up to 4.3%. So it was that, and then it was this yen carry trade where Japan, yen is the currency for Japan. Japan raised their interest rates. And we knew they were going to do this, but it was not televised well, or forecasted well. And so there was a massive amount of volatility. kind of argued there shouldn't have been as much because people knew this was going to happen. So the fact that everybody says things are not a big deal, sometimes the market seems to be way more clear-eyed and critical of foreign markets and less clear-eyed and critical of the US. So it was interesting, though. The unwind is serious, and I put that in perspective because whenever we see big swings in anything, whether it's the 10-year yield, whether it's oil, whether it's the stock market or the VIX, the volatility index going up, or anything like that, you have to put into context that there's only so much money being traded. So there's only so much money within the market, and that when you have volatility, that moves around. People have short covering and they're moving stuff around. So there's all kinds of stuff. And add into the fact that you have margin. So people are trading with money they don't actually have. And so then you have short covering and you have all kinds of things going on. So people have to sell to actually just pay stuff off. That's one thing. And then I saw or heard a note the other day when I was listening to Bloomberg Surveillance or one of the CNBC Squawk podcasts. And it was that we have the highest level of retail trading that we've had in, wait for this, 1999 and 2007. And so that's a really serious thing, meaning that, yes, the retailer is within the stock market. And if you're listening to, if you're following the oil side and you know the oil and gas industry, you know that the retail investor, the generalist investor, has really pulled out of, traditional fuels, particularly oil, natural gas, and coal. And so that's why when we think of retail investor, the role that the retail investors had on the market since COVID is pretty meaningful. And so when we think about where the stock market is at and how bloated it is or not bloated or froth, I think there's plenty of froth in the stock market. We all know that. But these volatile swings are, they're sort of telling you something, and they're telling you that people are not comfortable with the economy, or they wouldn't have had concerns about recession the way they did. And so you have the yen carry trade, you have people they were borrowing in yen and then investing dollars elsewhere. And so that exacerbated things when you had Japanese yen, they actually raised the interest rates. So that, coupled with a 4.3% unemployment, and I spoke about it briefly in that short video, but that 4.3% unemployment, it's the curve. So I go through this with clients and I really ask them to study it and look at it. And I talk about it when I do these keynotes and these talks and presentations. But when you look at that curve, it's really, really important. It's like a swoop. And if you're looking at my hands right now, you're watching a video, it's just a nice clean swoop upward. I'm not saying it's exponential, but typically what happens when you have rising unemployment is it just accelerates. And so, I will really throw a lot of caution on the market right now. And I'm not telling people what stocks to buy. I'm not a stock picker. I'm not a stock, I'm not covered for that. So I'm not advocating for any of that. But the caution is in how the stock market weeds, that's Wall Street versus Main Street. And, everybody they got the CPI print today on inflation, and they got all crazy, and everybody went nuts, and they're super excited that the Fed's going to lower interest rate. And so stocks moved higher. And the cautionary piece of that is that, people aren't paying attention to they were paying attention to unemployment when they got the jobs data, and now they're not. And so it's 4.3% unemployment. That's what they're saying. The Fed should lower interest rates partly because of that. A lot of Democrats and a lot of doves are sort of on that side of focus on unemployment, less on inflation. And I would say it's really important to think about that 4.3% unemployment. We still have very sticky inflation, and I'll walk folks through that. Why I am much more hawkish on that, and why I do think we do have this really sticky inflation. And part of that is because I think a lot of folks within the Fed and in Washington and New York need to get out to the rest of America and see how people are living and ask them how they're doing, because they're not doing well, and they're living on a fixed income. They're living paycheck to paycheck, and it's not like they were before. They were able to save money, and now they're not because of this inflation. So any kind of inflation on top of your already 40% higher grocery basket prices are really problematic. So the unemployment piece, why it's so important, is that it's the SOM rule, right? It's that SOM rule, I believe, is it's a half a percentage point uptick every year if you have that 3 months in a row, and basically we've had that. So we have this pretty nice uptick, but that basically it's a perfect indicator. It's never been wrong in the past 20 and 20 times. So it's a indicator telling you basically that you are looking toward a recession. And what's interesting today and the last couple of days is listening to Bloomberg and listening to CNBC is that so many people are like, well, we can't promise a recession. Jamie Dimon was talking about it in his interview with CNBC last week, is, we're definitely not going to recession, but it doesn't look good. I would say that you already have half the economy in recession. I've talked about this a lot, probably more than half the economy. Yes, you have wealthy consumers still going to Four Seasons. I listened to the CEO of Four Seasons talk today. I mean, spending $100,000 on a vacation, you have that obviously now. And people forget that in recessions, people don't stop eating, they don't stop driving, they don't stop going to work if they have jobs. the economy doesn't stop, it slows down. And so I think it's really, really important to start looking at like sectors of the economy that are slowing. And so when you see that unemployment uptick, and then why I thought it was very interesting, people didn't hone on this today, was that, Intel, told us that they were, not today, but in a few days ago, Intel told us that they were cutting 15,000 jobs. I mean, it's a lot. And Intel is also a recipient of this massive government funding to onshore and resource building chips here. But the burdens for some of the stuff have been so damn high that they haven't been able to do it. And so when you're asking companies to pay for daycare and all these things, that the costs get really out of hand. So the fact that Intel's cutting jobs, and the fact that we are supposed to have this AI driven boom, and the tech sector is the only thing that's running the stock market right now, or has been all year, and that yet they're cutting jobs, I think that's really serious. And then you had Cisco saying they're coming out today, and they cut I believe it was 7,000 jobs. So, these are meaningful, 15,000 here, 7,000 here. Talk to those people that have lost jobs, because 2 years ago, if they had lost jobs, they could probably get a job. I think the ability to actually get a new job that's what's tricky. And I've listened to some people, really, really good folks, talk on unemployment. And, people used to talk, especially in 2008 to 2010, it's peak of recession in 2010, underemployment and all the elements of that. But there's some stuff going on under the hood with regards to unemployment, with meaning that, you're not seeing the same postings for job hiring, right? People are not hiring the way they were before. And so the Fed is looking for the soft landing, and they think they're getting it because they say they're getting the labor force back into balance the way it was in 2019. And I don't think it is back into balance the way it was in 2019, because basically you let go all the people in leisure and hospitality because you shut in the economy. You pumped a crap ton of money into the economy, so people spent it instead of going out and doing their normal day-to-day business. And now you have a lag where people actually, a lot of boomers didn't go back into the workforce. People took early retirement. And so you have this lag impact, and you have this transfer wealth, and you have dislocations in the economy. You also have a massive amount of immigration in the US. And this is talked about on a number of different levels for folks. And people say, well, this is why politics get involved. And they say, if, we have a Trump administration, we won't have as much immigration. Well, and then that would be bad on the employment side. Well, you can't have your cake and eat it too. So if not having less immigration is going to hurt you on the employment side, and they're calling it Trumpflation, which I think is really fictitious, because it's actually not in the data. You can look at previous administrations, and going back to Obama, going back previously, we just haven't had inflation. We have inflation under this administration for a number of different reasons, not solely because of the administration, but in part due to the massive fiscal spending we have under Congress and the Biden administration. But the point is that when you have that influx of folks coming in, and the good chunk of the jobs being created are going to leisure and hospitality, they're going to lesser paid sectors, and a lot of immigrants are taking those jobs, partly because Americans don't want to take them. But the point is that that's not meaningfully, that's contributing to the economy in certain ways, but it doesn't mean that it's necessarily adding. If they're illegal immigrants, or if they're not paying taxes, or it's under the table, then that's not adding to the economy in that front. But the demand is still there from a housing perspective. And, that's very tricky to actually get down to. But you can see the charts in terms of the mass migration, and you have to just think, what's the ripple effects. You could call them not immigrants. You could just say one state of people moving to the next state, and you would have economic repercussions. So I think that's the way the Fed has been, when they talk about immigration, that's how they're trying to slice it and dice it a little bit. And they especially last year, and I've mentioned this before, they were talking about this, trying to figure out why GDP was so high. Now, you have this very, very mixed bag, where you have GDP, where people are saying, okay, GDP is still good in the US, the gross domestic product growth is still good in the US, but we have this rising unemployment, and we have so we have this weakness on the unemployment side, or this rising unemployment, but things still look really good, and now we have inflation cooling. And it's such a mixed bag. It's very, very hard for folks to get right. And we're not going to have, no recession looks like the previous one just perfectly. So if you're looking for a 2008 style recession, this one or this next recession will look different, partly because, like I said, half or more of the economy is, or the consumer's kind of already in it. But I would say, in terms of that, in terms of the unemployment side, and in terms of inflation, I think it's really meaningful in that, yes, you have pretty robust, decent unemployment, right? 4.3% is still not a bad number. It's not nearly, it's a percent higher than we were at our lows, about like 3.4%, where we had low inflation, pre-pandemic under the Trump administration. It was just a very, very different fiscal environment, and we were spending, but the regime was different, and what you were spending on were different things. So now you say this consumer price index comes out today, and it's 2.9%. So all items for inflation was 2.9%. This was bang in line with what the expectations were, not above, not below. So everybody's cheering on the stock market because Jerome Powell signaled a couple weeks ago that he was going to do this 25 base, or he was signaling that September was open to a rate cut, probably 25 basis points. And we can argue the merits shortly about what a 25 basis point cut, 0.25%, would actually do to the market. The market's going to move ahead of it, but it would be the signal that they're cutting. Now, that's so 2.9% for all items. If you look at electricity, that's almost it's almost still 5%. It's 4.9%. We're 18 cents a kilowatt hour. So I would wager electricity is a real risk there, and a really big pinch point, I think, for consumers. All items less food and energy was 3.3%. So that's your core. So your core is actually higher than your headline. And that's a big problem. So all items less food and energy is still 3.3%. That's 1.3% above 2%. Now, people say that maybe the Fed should be raising that the economy is doing better, and 2% is this fictitious target. Well, look, folks, if you went from no inflation or 1 to 2%, and then you went to skyrocket inflation, and you're paying so much more at the grocery store than you were before. If you can't get it back, even if you can't get it down to where you're having very, very minimal increases, you're really going to put the consumer out of reach. And that's what you're seeing in terms of what stores are telling you. I cannot bang home enough. Like, think about Starbucks. Go into a Starbucks and see how it looks. See how many people are buying coffee, and you realize not a lot are buying coffee. You hear that in the earnings. They just got a new CEO, effective immediately. It was the former Chipotle CEO. And the problem with Starbucks is that there is no entry cost item. And I said this in the short video when I was in Craig, but we went to McDonald's. I haven't been in years. And my folks were telling me how expensive it was for the two of them to go to Wendy's. And this was before they did these $5 menus, and it was like $50 for two people. It was absolutely insane. So we went to McDonald's and we got the $5 menu. I ended up getting a big kids meal, which was actually not horrible. It's like six piece chicken nuggets. They forgot my drink, but you get apples and a very tiny little cute fry. And it's like five something. Still a little expensive. I think they could clean that up at $5. But the $5 menu is a double McCheeseburger, a four-piece nugget, and a small fry and a drink for $5. And so we were able to feed a car full of my two nieces and my mom and myself and I got a iced coffee. And I think this is why I'm relating this to Starbucks. I got a black iced coffee, which I still think are great. It's at McDonald's for $2.19. There is no entry point item for Starbucks. So Starbucks is doing these rewards things. My niece just had her birthday, and so she went there for her birthday and she got her birthday drink. But there's no entry point item. A black coffee, and when I'm traveling, especially if I'm traveling with my nieces or something, I'm budgeting on that front. And so we'll go into Starbucks for breakfast and get a breakfast sandwich, which is $5, and a coffee. But the cheapest coffee, a black coffee, is $4. And so a black coffee, that's too expensive. So I do think they need a lower entry point item. People keep saying, well, they need to do, like yesterday, you heard everyone in the stock market saying they need to focus on the stores, they need to have greeters, they need to do a better job. And absolutely, they need to do a better job. But if the reason they're not selling stuff is because people are still going to Four Seasons spending $100,000 a year. That's not what's slowing down Starbucks. It's the everyday person that doesn't have the $5 or feel like it's comfortable spending $5 for a black cup of coffee. And that I think is really, really important. So back to these inflation numbers. So all items less food and energy is 3.3%. Shelter, and that's the sticky one. That's the one people like when they're like, oh, everything's fine, just take out shelter. And everybody said that today. Just take out shelter. It's no big deal. And, they can't control for shelter, which is absolutely ridiculous because that's what the Fed should have been addressing is housing. And they can't, if they lower interest rates, shelter prices will rise because you're going to, any pent up demand or anything you had to pull down on prices on housing could be pushed back up. And I want to come back to that in the stock market and companies as well, lowering interest rates and borrowing, which is inflationary, but also if you have actual deflation, especially in good groceries and in clothing, then you're going to actually see problems on the margin side for earnings for companies. But shelter is still above 5. It's at 5.1%. And then you have services, less food and energy services less energy services, sorry, is it 4.9% still. So those are still very, very high. And so you still have an uptick in wage gains. And so people keep saying, oh, well, the wage gains are up. And so we're there. We're not there. There's no there. And people are looking for soft landing, and increasingly people are talking about a no landing. It's very, very hard for the Fed to land a soft landing, to really stick it. And I think it's going to be very, very difficult. And that's why you have so many people calling saying, oh my gosh, I mean, when we had this yen carry trade and we had this unwinding and you got the jobs curve, people went nuts. And they said they were calling for an emergency Fed rate cut of 75 basis point, which was insane. So that's immediate reaction that's not correct. And what would it do? I mean, so there, if we go into recession, the Fed is going to cut rates. If the Fed aggressively cuts rates now, it's going to tell you that it could spook the market in saying we are going into recession. And so the Fed wants to have its cake and eat it too. And the economy and the stock market and all the pundits want to have their cake and eat it too and say we need lower interest rates and then we're not going to go into recession. Probably just not going to have it that way. And I contend that, people keep talking about interest rates and inflation. And they say that, well, the Fed needs lower interest rates and lower income consumer will do better. I mean, they have this correlated that the lower income consumer is not consuming because of high interest rates, meaning that apparently the low income consumer, if that's the case, then the low income consumer was spending everything at McDonald's and Starbucks and Lululemon and Walmart. They were doing that on debt. And that's ridiculous. So one, they had stimulus and they were spending too much and stuff probably on they shouldn't have, on TVs and everybody went crazy. And then, but two, lower income consumers often paycheck to paycheck. So if you're paycheck to paycheck and then you have massive inflation, now you just can't spend because you're really tapped out because we had years of this incredible inflation. And now you have a weakening economy where people just don't feel as good and it's harder to move jobs. You are seeing a lot of companies actually do these things where it's like quiet firing or they like move people in different positions and then they hate it and then they leave. And you're seeing people actually do a lot of part-time employment, which is lowering. So you don't actually have unemployment rising, but you have people on part-time or people furloughed where they're not collecting unemployment. You're not seeing that uptick, but they're not actually they're lowering the work week. And so if you're lowering the work week, that's not a healthy sign for the economy. And so we're seeing these things under the hood that I think are really, really serious. And just thinking about the average consumer, or middle income consumer, how much they're tapped out by inflation. And that is what is lowering prices, folks. It is not the Fed who has raised interest rates and he's lowering prices at McDonald's. McDonald's is still seeing the higher prices. They're just losing customers so much that they've had to do the $5 menu to get people back into the store. It's a loss leader. And so that has nothing to do with the Fed. That is the fact that the Fed has not done their job. They haven't lowered inflation. They have not lowered prices. And these customers pushing back and not spending, it is what's pushing back and it's lowering prices. And truthfully, the consumer has to do it. The economy, and I say this, we do need a reset. It's not sustainable the way it is to have these rising prices and a weakening economy. And that's where, it may not be 1970s style inflation and 1970s style stagflation, but I think we do have elements of stagflation where you have elements of sticky inflation and elements of where you have rising unemployment. And the Phillips curve is a nerdy economic curve that everybody wants to be on. We had it pre-COVID. We had it's called low inflation. And so when you have low inflation and you have low unemployment, everybody studies in economics and they look at Switzerland and they say, oh my gosh, look at what Switzerland, they have low inflation and they have low unemployment. That's where we were. There are policies that actually do that, and people have to think about that. High government spending, especially on entitlement programs, are not the things that are going to give you low inflation and low unemployment. So now that you have this sort of rising unemployment, that means you have this weakening consumer. That's a big problem. And then you think about the inflationary piece and what's driving that inflation. Well, think about the things that Jamie Dimon talks about. He talks about the things that those of us who are following geopolitics, which we're going to pivot into, is the rearmament of reinvesting in militaries from the US to Europe around the world. That's inflationary. Any kind of government spending is inflationary. The Inflation Reduction Act, which is a massive amount of government spending, is inflationary. Anything you're spending on green energy, especially because it's such poor forms of energy, especially wind and solar, it's inflationary. We see this a direct correlation with wind and solar penetration into the grid increases your cost of electricity for a number of different reasons, because those utility companies are passing on those rate hikes to the consumer. But it's really serious. And I'm going to be doing a podcast with Chris Brown with the Common Sense Institute tomorrow. And we're going to be talking about the report that I just did with Stephen Byers, who's their economist at the Common Sense Institute. And we co-authored this report together where they have this color is energy competitive. So it's the energy competitiveness index. And what we highlight in there and what I tried to really bring out is a few things. It's the rising cost of electricity, the decline in reliability, and the of electricity in Colorado, the rising costs in natural gas prices across all spaces. So from 2018 to 2023, you have a massive rise in electricity prices for residential, for commercial, and industrial, and you have a rise in natural gas prices for all three of those as well. And then what you also see is that there's a direct correlation with those rise in prices and the rise in wind and solar into the grid. And that's what we see. You see it in JP Morgan reports, you see it across the board. There's a direct correlation between wind and solar penetration into grids and rising electricity costs. We see the same thing for the US. But I'll be talking about that report and all the nuts and bolts and everything in between, and electricity and all that stuff. I'll be talking about that tomorrow. So that's just a little shout out for me being an energy fellow at the Common Sense Institute, and a shout out to the Common Sense Institute. So with that, we're going to pivot and we're going to go into oil prices and geopolitics. And expect a lot of volatility. We'll hold that for just 1 second in oil prices and geopolitics. Expect continued volatility, especially in the oil price front and especially in the 10-year yield, because those are tracking in line with each other. But we do have Jerome Powell speaking on, it's either August 22nd or 22nd to 24th. He'll be at the Jackson Hole, the big symposium that they do. So he'll be speaking there, and everyone's looking for him right now to signal this rate cut that will be in September. But keep in mind that interest rates are at 5.5%, and so we have this headline inflation of 2.9%, actually 3.3%, and we know it's much higher than that. And then realize that, so even if the Fed lowers that interest rate a little bit, what is that going to do? And I would argue that it's going to fuel inflation. So it's going to fuel inflation, especially in stocks, because the stocks are already geared up for it. So that means that you're going to have material earnings growth in stocks and a good economy, and we don't have that. So there's no real growth story for the stock market, just like there's no real growth story for demand for oil. So if you have a decline, if we have a material decline, we actually have prices declining, or we have a disinflationary or disinflation or deflation, outright deflation, and you see lower prices for clothing or groceries, that means that your stores are, the basket of goods, it could be smaller. So something that you've seen within the stock market is that the basket of goods, the prices, because they were higher, that means the earnings for the companies are higher. So they may be buying, a t-shirt at Walmart might have cost $10 before COVID, and now maybe it costs $20. That's an example. I'm sure Walmart's doing better than that. But say it costs $20 now. The consumer might have purchased 2 t-shirts at pre-COVID, and now they're only purchasing 1. Now the earnings or the outlook or the money that they're getting is the same, but that if those prices decline and the economy is deteriorating with it, that's going to look differently. That means that you have some real risk, I think, to the downside for the stock market for earnings from that perspective if you have deflation or disinflation. And I think you see that in China. And so as we pivot into geopolitics, I do think the big trends that you hear folks talking about within the economy is the health of the US consumer and the softness in China. And why that's so important is because that softness in China, they have disinflation in China. They have, we just got more housing data that was bad for home sales within China. And people always say, okay, it's home prices and they're not great, but that's just the property sector and they're going to continue, and they're muddling through. Well, they are muddling through, but people have to realize that the reason people aren't buying stuff in China is because so much of their wealth was tied up in home values, right? They might have 5 apartments as an investment because they don't invest in the stock market like we do. And so now that that's declined, or they even haven't built some of these homes that they bought, the people don't have the money or the stability or the good feelings to actually go out and buy stuff. And so that's what's weighing on that there. So companies like Starbucks, who are getting hammered in the US because the consumer, the aspirational consumer and the regular consumer is not buying that $4 black cup of coffee, or let alone the $10 venti caramel frappuccino, whatever, which is insanely priced. They're not buying that, but they have a China problem as well. And you're hearing that from McDonald's and Starbucks as well. And that China problem is multifold. So it's multifold from the economic standpoint, but it's also multifold because these folks in China can't afford these Western prices. And so what they've seen is a lot of domestic places like Luckin Coffee, like some fast food chains, really take a bite out, literally and figuratively, because they've keep their rock bottom price. They're lowering their prices, and so they're getting those consumers in. But if you're listening to things like Drum Tower, that's a really, really good China podcast from The Economist. They talk a lot about the China economy and the average consumer and what's just going on the ground. And it's just slow. It's not great. And I think we have to be just very concerned if you're looking at companies like Starbucks and Walmart. And so if we have time, I'll get more into China, but we're going to pivot into this geopolitics, because we have $77 oil right now. We have 79 Brent, and yet we have two hot wars going on right now. And I heard somebody tonight on from this morning on Bloomberg Surveillance when I was listening to the podcast, walking my dog, Axel. I heard them say they were like, this woman was saying she was, she was thought dirty energy was a good bet. And it was just funny. She called it dirty energy because she called it dirty energy and she called it warm wars. And one, it's amazing because that dirty energy or those traditional fuels that people don't like, those are what's saving everybody's ass right now. And two, they're not warm wars, they're very hot. So it is very, very fascinating and very telling for a lot of different reasons that oil prices are not higher than they are right now, given you had Ukraine go into Russia. So I wouldn't call it an invasion because it's not the same thing that Russia did in its retaliation, but it is a escalation in this war. And there's a number of different reasons why they did this. I would encourage you to go to the Institute for Study of War and check out some of the maps and what they have on there. I spent a while listening to some podcasts over the weekend, really ripping through and getting some perspective from folks. It's not completely clear, and obviously, it's very interesting that the Biden administration is pretty mute on this, of saying, Ukraine has now went into Russia and they've brought this war to them. Now, obviously, there are advantages for Ukraine doing that because it means that they could incentivize them to come to the tables for ceasefire or some negotiation. So you can't see this in the black and white. You can't see this really well, but I encourage you to go to Institute for Study of War so you can see these maps. You can see the penetration that Ukraine has moved into Russia. And this was it seemed to, at least from the local yokel or interesting podcasts, I found a couple of Eastern Border that I was listening to. I don't know how perfect they are, but these folks seem to have done their research, and it seemed that this was not something that Russia expected, partly because they didn't think that the West would sort of allow this. But I think it is very interesting right now that we are not hearing more on the political front. You are hearing folks talk about now, casually talk about Biden being senile on the, at least from CNBC and Bloomberg, what I'm hearing. And that's really scary from a geopolitical front, because that means that we don't have clarity to who's running the ship in the US. And so I do think absolutely with Biden stepping down as the presidential nominee and Harris stepping up, it means that if he wasn't able to run a campaign, the question is how effective can he actually run the Oval Office, and how effectively can he run the U.S. And so I think the risk of the fact that we are so busy and preoccupied with the U.S. economy and we're busy and preoccupied with U.S. politics, the risk that we have escalation and geopolitical risk, not necessarily attack on the U.S., but potentially or attack on U.S. bases, that risk has risen for sure. But geopolitical risk has risen, and we've already seen that unfold. So we've already seen this Ukraine Russia escalation where and I'm not weighing in and saying Ukraine should not have done this, but I'm saying that is an escalation. So then that could be an escalation in Ukraine's favor, where that pushes Russia and pushes them to pivot, and there's all kinds of problems within the Russian military. So but that's one. So that's very, very hot. And if that impacts oil production or energy production in any way, that's obviously pressure on oil prices. And we're going to get into why a jump in oil prices is going to be really, really problematic to that economy that I've just been explaining to you, because the US economy, and I think, and the Chinese economy, and every economy cannot actually probably handle a $90 WTI or a $95 Brent. I don't think they're in a position to actually handle that. And that price spike could be something that really moves the needle on the economy. But so you have that hot war, you have the escalation within Ukraine. As I dive deeper into that, I will bring that coverage to you guys. But Iran, I talked about this briefly in my intro to the previous podcast and a little bit on some short snippets. But we have Hezbollah attacking Iran, or Hezbollah to the north, which is in Lebanon. Hezbollah in Lebanon, which is one of the H's, one of the Iranian-backed groups. They've been attacking. They've been actually attacking Israel since the war on October 7th started. So they have had sympathetic, they basically came out vocally and said they were in sympathy with Hamas and they were going to do these attacks. That's escalated. And so what you really see is that every time there's a try to be a calm in the waters, it just gets blown up, literally. And so what you saw when we saw this pullback in oil prices, we saw 79 WTI, and then we saw this pullback to 77. And you see a line on CNBC, a tagline in quotes: "Oil prices fall after Biden says Iran could refrain from attacking Israel if ceasefire deal reached." End quote. So that, he's saying basically we could get a ceasefire deal if Israel says if they come to the table. What we've heard from Hamas is that Hamas says that Israel must basically stop everything within Gaza before they agree to a ceasefire. And the fact that you are dealing with Iran directly, it takes all the BS out of the thinking that Iran is not it is Iran. You're dealing with Iran. And so now that we have Iran saying that they were going to retaliate because Israel was able to get their leader, Israel was able to assassinate the leader of Hamas, one of the leaders of Hamas, within the capital of Iran, in Tehran. They were able to assassinate them a couple weeks ago, or a few weeks ago, maybe 2 weeks ago. And Iran says they're going to retaliate. And Iran, for many reasons, has to, for the hardliners and everything. But every time you see any attempt for a ceasefire, something picks up. So we haven't heard much about Houthis in the Red Sea. That's ongoing. But you're not going to see anything, if anything quells somewhere and you get a ceasefire, you're going to see uptick somewhere else. So it's very clear that these folks within Hamas and Hezbollah and Houthis don't want this to end. And so they're escalating and ratcheting it up. And so the risk on oil prices is very material and real. But the fact that we're not breaching that $80 level sustainably, and we have this going on is really serious. And that could be partly, that is partly because we do have a lot of spare capacity on the market. And that's also partly because we had the IEA, the International Energy Agency, come out with their monthly outlook this week. And then we also had OPEC come out with their monthly outlook. And both had revisions to demand on the downside. So IEA, some very interesting nuggets in there actually, especially on refining margins, which I'll talk about if I have time. But OPEC, they revised their demand down just slightly. It was just over 100,000 barrels a day. But the fact that they did it is pretty material. It means that they're signaling, that they're at least saying or acknowledging, not signaling, acknowledging that we're having a downside price or we're having some downside risk from a demand side. Now, obviously, it's bigger from the IEA, and they're saying demand is coming off, and they note China. And I think even their data on China, I think, is really I looked at the charts because I buy that monthly report, and it's you can look at gas, oil, diesel demand in China, and you can look at gasoline demand, and so a lot of it they're attributing the decline in gasoline demand in China. They're saying that's electric vehicles, and part of that could be actually in China because they do have so many electric vehicles. But the fact that we don't see, the fact that they still have very, very robust around 16, 17 million barrels a day demand, but they have the declining increase. It just, when I look at the 2019 numbers and all those charts, it makes no sense to me that China dramatically rose, from the levels that they were, something like 15 million barrels a day to 17 million barrels a day between 2019 and now. And that time period was when they went through COVID and when they had these zero COVID lockdowns. And so one, a lot of that is it's just not real, right? It's stockpiling, and it's all kinds of things China's doing with the economy. And then two, it's that looking at that gas, oil, that diesel side. And that's where it looks too robust for the fact that the weakness in the property sector exists, and the fact that you're hearing this stuff. Now, the problem is that China is just a massive, massive country. And so getting, understanding that and getting depth on that is going to be really hard. And I do think the war footing that they're on, the fact that they are supporting this war with Russia, they're building stuff. They're building equipment. They're building tech. They're sending them ammunition. And all that takes, all that's actually, that's helping their economy. A lot of their economy right now is about staying afloat. It's about dumping exports on the market. They talked about it in their third plenum that they were doubling. They were going to continue to be exporting. They're continue to be going down the EV and the electric vehicle, the solar, the wind, and a lot of that's that sort of old playbook that we know. It's both new and old, but it's the old playbook in terms of the manufacturing powerhouse doubling down and exporting it. But all of that does, to an extent, that is supportive to a degree on the oil side. So I do not believe that the Chinese economy is consuming 17 million barrels a day, but I don't think it's not nothing either. And the question is, how much are they actually consuming? How much are they stockpiling? And what's going on there? The economy is not healthy. They're not robustly doing things, but because it's so big and because there's lots of stuff going on and because they are subsidizing so many things and then exporting it, there's a lot of inefficiencies within the market. So it means that our color on oil demand is not perfect. But I do think the overall sentiment in terms of thinking growth, they're not going to grow. And I think that's finally something that OPEC is not acknowledging. They're thinking about to a degree. And I think it's obviously something that IEA is talking about. So it's that oil demand growth within China. And this, I'm talking about, thinking about Starbucks, thinking about McDonald's. That's just not them. That's one, them pivoting away from Western stuff. That's also them being tapped out and them not spending or being concerned about the economy and going down to lower price domestic stuff. And so all that's not healthy from an economic standpoint for China. Okay, pivoting back on oil. So we think about that from an oil price standpoint. Well, we do know that China is buying a lot of Iranian crude. And so when we think about what the Biden administration is saying on oil, a massive amount of concern in this run up to this election that we are going to have a spike in oil prices. Now, like I said, if we have a spike in oil prices and we push north of 85, I think we start seeing I don't know if we start seeing demand destruction. I think we start seeing real concerns within the economy where you have good everything, escalation in prices. And so you really throw some cold water on this, inflation coming down. And if you remember what 2008 looked like when we had that big spike in oil and then it came down, um, I'm not saying it's going to look like that, but it could. With a tapped out consumer, if you spike to $90 a barrel because you have these wars, that's problematic. Now, the reason we're not seeing some of those price spikes is because of all the spare capacity. So we know that Iran is producing well over 3 million barrels a day, and probably over 2 million barrels a day is going to China. So we could really throttle Iran's ability to continue supplying, continue aiding and abetting and supplying the, Hamas and Hezbollah and Houthis with all this weaponry and tech. Now, unfortunately, it's really cheap tech. A lot of this, they're doing stuff very, very effectively, as a non-state actors with very cheap technology, but they are supplying drones and weapons to Russia, and this is also going on. So I'm not saying you're going to stop this overnight, but we are not enforcing sanctions on Iran right now. We haven't been over this entire administration. And so you've seen this escalation with this dovish on Iran from the beginning of this administration to now. And so now under the Biden administration, you have these escalating hot wars, and it is a really, really big problem. So if we were to start saying, hey, we are going to start seizing ships from Iran that are going to China, it's gonna increase oil prices. But if we got a deal, we brokered a deal with Saudi Arabia, and we gave them something, and they clearly want a lot of things. And I think that's potentially in the works, is that if we brokered a deal and said, okay, Saudi Arabia, you're only producing 9 million barrels a day. Can you bring a couple million barrels a day back, and we can sanction this? They may or may not do that. The problem is that then involves them in this conflict. I don't think they have as good of rapprochement as people think they do with Iran. But the problem is that you have Iran and North Korea and Russia and China heavily involved. And I wouldn't say they're fortified. Like I've said in previous talks and presentations, this is not a healthy marriage, but it's a marriage. And lots of marriages are not healthy, and they create a lot of havoc and wreak a lot of havoc on families and extending families. So this is one of those wonky relationships and marriage that is wreaking a lot of havoc, and it's going to continue. So one of the things that the Biden administration could do, and future administrations could do, whether it's Harris or Trump, would be to implement sanctions, the existing sanctions on Iran, and curtail those shipments to China. And it would, I think there's a double fold thing that would be beneficial there. You could do it in a slowing economy if the demand slows down. But it'd be if we were to implement sanctions, say on China for supplying weapons and aiding Russia, this could aid that. So we could basically say, hey, you can't sell this, China. You can't be buying this stuff. And so you'd be doing that. Now, say it's 2 million barrels a day. Say we're going after 500,000 barrels a day. And so we just see what happens in a reaction. The Biden administration, a Trump administration, a Harris administration, they're not going to. A Harris administration most definitely will not go to the oil and gas industry and say, hey, can you produce more? What can we do? If we built Keystone XL, if we had more crude flowing from the Canadian oil sands, we've already seen a material uptick in Canadian production and the ability for Canada to produce more now that they have their expansion pipeline online. If you were able to if you were to put some more redundancy in the pipeline system, I think you could get more Canadian crude into the US. We're getting over 4 million barrels a day now. But if we added that and then we said, okay, producers, what can we do? Can we refill the SPR? There's a number of different things we could incentivize US producers to actually increase production. Actually, probably wouldn't want to increase the SPR because you'd be taking production. Somebody's going to need to do that in the future. But so you could be asking them to add a few 100,000 barrels a day and to see what we could do there. And I think simultaneously you could be going to other countries around the world and doing the same thing, and giving actually probably an excuse for countries like Norway and folks in the UK to actually increase output in the name of security and quelling these wars. So that would be meaningful. And then the problem is, and a real concern with Russia is that if Russian production declines, and Russian production has been really, really robust throughout this war, and I've talked about that at length. It's been very, very robust, and we obviously see that in oil prices, and we see that we're pretty well supplied. Saudi Arabia is producing 9. The numbers for Russia are really, really wonky right now because it seems like all the data is taking out condensate, whereas it had that in before, and so Russian production was somewhere we're in the high 10 to 11 million barrels a day, and now it's saying it's 9 point something and change, right along with Saudi. I don't seem to buy that, and it seems really wonky. But the point is that if Russian production was to be hit, or if they limited output, or even just if refineries were hit, that's really problematic, and that could also push prices upwards. So I don't think that geopolitical risk premium in some is as high as it should be right now, given that women said warm wars, they are very hot, and the fact that they could escalate and go quickly. Now, that is obviously being weighed on and offset by this concerns in China, this softness in China, this weakening consumer in the U.S., and a overwhelm and the fact that we have all the spare capacity and we have a few million, a couple million barrels a day at least of spare capacity within Saudi Arabia and probably a million barrels a day elsewhere. So easily 3 million barrels a day of spare capacity and probably more elsewhere. And then you just have very robust production out of the US. We're about 13.2 million barrels a day. It's been sort of flattish in areas month over month, but you have increasing production out of Canada, you have increasing production out of Brazil. Basically, everywhere that's non OPEC, you have increasing output. And so that's the push and pull, and that's what's weighing on prices. And then, back to what I was talking about earlier, if you're looking at the 10-year yield and you're looking at WTI, and something I showing a lot of different chart variations with clients and not as much in presentations because it's a little too in the weeds. But if you look at that, they're tracking. And it's interesting that they're tracking in the way that they're tracking, and that's because they're bets on the economy. So typically, if you have a decline in oil prices, and right now at least you're having that decline in the 10-year yield because people are, yes, inflation is coming down, but that also means that you're not growing. And so we have to be very, very careful thinking about what oil prices and what the 10-year yield and what inflation is actually telling us about the economy and the consumer. So I have covered a massive amount in a short time period, really focusing on the Fed, interest rates, the U.S. consumer and the economy, and geopolitics and volatility. I will be spending way more time on the geopolitics and oil price volatility, and I think it's just keep watching that space. I think the risks to the upside are absolutely real, mainly from a fear factor, and are probably not priced in appropriately. I think it was Amrita Sen with Energy Aspects. I heard her say on the stock market the other day, and I've known her for years, but I heard her say something like a $4 risk premium. That seems really, really low. If it's a $4 risk premium, that means that the underlying fundamentals are sort of $75 oil, and I don't buy that. I think that the geopolitical risk premium is at least 10, and I think that means that the fundamentals are lower. And so we really have to be careful about what is the underlying fundamentals of that supply demand and what are they telling us and where are we actually at. And so everybody's sort of chugging along when we think about the economy and you think about stock market coverage of where we're at. Everybody's sort of chugging along that it's okay right now, and it's okay till it's not. And I think that's what that spike up in the VIX, the yen, the carry trade, the unwinding, and the sell off in stocks, the unemployment to 4.3%. All of that it was overdone of a fear side, an immediate sell off, but it was also that fear of people are thinking, oh my gosh, is that the straw that's breaking the camel's back? Is that the thing? And there are a lot of, as I've said, a lot of black swans in the water that are just kind of, we know about them and they can swim up to you. So we have to be very, very careful about that. And then thinking about where is the real health. And you constantly, when you're listening to the stock market, you always hear, well, like, oh, it's fine. We'll just invest in good companies. And, Walmart is a company that is like your major hedge. It's still too expensive, I think, to buy, at least for me right now. But it's that company that's like the hedge because it does well when it's doing real well right now because it's helping folks combat inflation. I mean, I can't tell you how much I look at prices at Walmart, especially on food, because they're at least trying to move things back in line. But because so much of their basket is grocery, I mean, so they're driving people into their store, but I think it's something like, it's like 60% grocery and they're like 25% of the US market. So they're this nice hedge on the consumer in terms of if you're thinking recession, you think that, Walmart's going to do well because people are going to go there. But also they've done well because they're combating inflation, but also is the valuation of their earnings, is it valued too high? And I think that's the problem, is that everything we're sort of seeing is there. And so that's the risk of that. And I say this for Wall Street to Main Street, because when you have a sell off like that, that's where people start freaking out. And that's where it comes and it weighs into oil. And a sell off, a $5 swing in oil, I say this a lot, a $5 swing in oil is really trading. It's really algorithmic trading and it's volatility. It's really, at the end of the day, when we come back to supply and demand fundamentals, where do we actually sit? So I'm going to leave it with that. Forthcoming podcast. If you have not listened to the latest podcast, episode 112, the keynote address with the AAPL, the American Association of Petroleum Landmen, it is really, really good. I mean, I'm really humbled by the reviews I've gotten and the feedback and everything. And I can tell you, people are needing intel right now. And I know that because when I know I get 200 views in a weekend, and it's an hour and a half long talk, and it's just me talking shop and, throwing out this intel as much as possible, and a lot of it, sort of on a fire hose level, and that people are watching that just on YouTube. I mean, there's thousands of listeners, but that means that people are craving this intel. So please take a listen on iTunes or YouTube or Spotify, wherever you listen. It's on there. Take a listen. And then if you haven't, if you're considering sponsoring the podcast, now is a really good time, because the people are demanding this intel. I do want to keep this podcast free. I want it in the marketplace. I want this information out there. I want to do more speaking, and I want to get this intel out there. So there's often people ask me this, and I want to talk about this a little bit before I close. But people often ask, when they're talking to me, and I get cold calls, and they say they've been following the podcast and they want me to come in and talk, or they want to know how they can work with me. And I want to just remind listeners that the podcast is a summary. It's a high level of what I am doing covering the economy. The deep stuff is what I go into with clients, and it's really walking them through everything. And, market intelligence, this is sometimes really, really great for the right client. And it's right timing, right? It's where you have to be open to it, and you have to be able to, how can you use actionable insights, and how are you thinking about the market, and what holes do you have to fill? And that is what I do. I help fill those holes. And I work with folks in and outside the oil and gas industry, a lot of boards, a lot of C-suites, and also, other entities and other government agencies and heavily involved in and interested in investing in the geopolitics side. But please take a listen to that latest podcast. That's a great example of just cramming, all the work being put into one thing, and still high level, but it's still in the weeds. And think about if you're, wanting to dissect any segment of that, any segment of these podcasts can be broken down into hours of intel in terms of thinking about that, how that impacts your business. And then the forthcoming podcast, there's a couple coming up. And so the talk that I did in New Mexico in Albuquerque with the Independent Petroleum Association of New Mexico, that is just, it's such a fun talk, and it's such a fun group of folks. I'm a little bit more, I'm a little less shy on the politics side, given the dynamic of the group in the room. So really can't wait for that to drop. This one, obviously, this is episode 113, so that's going to drop soon. But I'm going to have Chris Brown from Common Sense Institute on the podcast to talk about this energy competitiveness index in Colorado, and to talk about electricity prices and everything. And it's not just about Colorado; it is about electricity prices and where we're getting our power generation in the U.S. more broadly. So that's what's going on. And then lately, I've had a lot of people asking me where I'm speaking, where they can see me. So the big things on the calendar right now, and I'm not saying no to things in October, but publicly, the things I'm speaking at in November is the Oklahoma Petroleum Alliance. Their meeting is in mid-November. I think it's the 13th or 14th. I'll be speaking there. And then the following week, I'll be in Midland, and I'll be speaking at the Society for Petroleum Engineers. I think their quarterly event. It's going to be really awesome like lunch thing. We're going to do a sort of hour-long deep dive, and then fireside chat Q&A. So super pumped to be coming to Midland. And I'm also working on a deep shale dive and a deep shale study, which I want to be public and out in the public and out for domain, so people can have a level set on what's going on in terms of what's going on in the shale space and activity and completions and productivity, decline curves, and efficiency gains, and really wrestling with what's going on with this lower material rig count and the longer lateral lengths. So I'll be doing that, and I'm looking to, I want to spend some time in the field when I'm out in Oklahoma, as well as when I'm in Midland talking with operators, not just the clients I have, but folks that are not. And I would love opportunity to come to the field. So with that, folks, I really, really appreciate you guys listening. Really appreciate folks reaching out, and reach out on the website at the click the contact us and reach out to me, and we can talk about podcast sponsorship or just supporting PetroNerds, and getting more involved. And if there's any kind of incentive, if you're watching the YouTube right now, you're going to see this awesome shirt. So this is a PetroNerd shirt. So think about that, of becoming a PetroNerd. I think I might add I am a PetroNerd on these. But we're going to have some sweetheart deals for folks who are sponsors on the PetroNerds front, and we have had a lot of folks in asking about merchandise as well. So I'll be working on that. So with that, folks, thank you so much, and I will talk to you soon. Bye.